if velocity is even flattening out, we have a problem. And we could be looking at a hard landing.
In today's video, ARK CEO, CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
There is a hard landing possibility here as well, but there's a very simple identity in economics. Most people who take macroeconomics 101 learn it in that class. And it is that MV equals PQ. So PQ is price times quantity, and that's nominal GDP of the economy. So the production of goods and services in the economy. The other side of that, and these two have to equal, is MV. Well, we know that money supply on a year-over-year basis is going down about 3% year over year, our estimate for March. And on a sequential basis, it's going down even more rapidly. So to plug that hole and to figure out what's going to go on here, we need to know what V is. V is the residual value. And if you look at what happened in the first quarter, it looks like nominal GDP was up roughly 7%. We have these numbers, I'm just rounding them. Up roughly 7% on a year-over-year basis. You've got money down 3, so that means velocity was up roughly 10 on a year-over-year basis. Now, velocity, if you look at it over history, you'll see that it peaked secularly in 1997 and has been falling from a trend point of view ever since then. Now, what happens is during a recession or a crisis is velocity falls dramatically. It collapsed during COVID, for example, and during 08-09. And after the shock of those experiences, it tends to rebound back to trend before resuming its decline. Well, it started rebounding. It has not gotten back to that downtrend line. And what worries us and focuses us on the possibility of a hard landing is the crisis, the banking crisis. Typically during a crisis, velocity falls, as I mentioned before. The banking crisis happened in mid-March. And so if velocity is even flattening out, we have a problem. And we could be looking at a hard landing. Now, you'll notice that the stock market is still up year to date. And we'll talk about that in a minute. We think there are reasons for that. But just back to this hard landing, if money continues down and velocity even flattens out here, then on a year-over-year basis, it's going to be slowing dramatically from 10% in the first quarter to 5 to 7% in the second quarter. And if money is down 4%, well, that doesn't leave much room for nominal GDP growth. So if money is down, let's just say it's down 4%, and velocity is only up 7%, let's say, instead of 10% on a year-over-year basis, which means it's flattened out quarterly. So that's in response to the crisis. Then that only leaves 3% for nominal GDP growth. And that's much lower on a year-over-year basis than what people are expecting for the second quarter that we're in. Now, maybe it'll take a little bit of time to play out, but we do think that 2 to 3% nominal GDP growth or less at some point this year on a year-over-year basis is going to happen. And so something's going to give. What is it? What's going to give? We don't know. It could be consumption if the unemployment rate starts moving up. And there are some indications that we're going to have some significant surprises in terms of the unemployment rate going up. So, interestingly, in learning today that Governors Waller and one other Bullard are saying inflation's still too high. We've got to stay tough. I went and looked at their backgrounds, and I think this is true of most people on the Fed. They have no market experience, and therefore I don't think they respect market signals. The surprise to me, though, is they're economists, as many of the people on the Fed are. They're economists, so at least they should be doing this very basic, if M is falling and V is threatening to flatten out or fall, what happens to nominal GDP? So hopefully they will start talking about it. One of the good things that we did hear during the last week is a new Fed governor, Austin Goolsbee, Chicago Fed, is actually saying, you know what? The credit markets are tightening up here, and they're doing a lot of work for the Fed in terms of slowing things down. And I'm going to go out and I'm going to talk to some of these regional banks and get a sense of credit conditions out there. And we do know that surveys on willingness to lend have collapsed here. So I think he's going to find out that, yes, that's right. So here is someone on the Fed who is, willing to go out and kick the tires and try and figure out what's really going on out there. So that's good news. One of the other pieces of good news from a monetary policy point of view is that Canada, Australia, India, and Singapore, I think this past week, have all gone on hold. And so they're looking at something concerning. And my guess is it's a very serious downturn and price deflation in a lot of trade indicators, which will come back to us. So we'll get into why the markets have held up so well. But first, let's do some economic statistics. Now, most of the statistics that have come out recently, that they were taken, or the measurements were taken pre-regional bank crisis. So I'm not sure we should pay too much attention to them. The positive ones were on housing, and I think it's because mortgage rates have come down since the long-term Treasury bond yield peaked last October at 4.3%. Finally, mortgage rates started to come down. So housing starts, permits, mortgage applications, existing home sales, and pending home sales all have done a little better. I mean, housing by many measures was down 40% year over year. So I suppose we shouldn't be surprised to see some rebound there. Autos they're still in recession territory at 14.82, but they came in a little better than expected. But other than that, even before the crisis, a lot of indicators were starting to signal trouble. So employment indicators like job openings have come down fairly dramatically. They peaked at 12 million at one point. Now we're down to 9.9. The Challenger Job Survey of layoffs, which are the larger layoffs, that's up more than 400% year over year. And maybe the most important indicator is initial claims, which were revised recently. And at turning points, as I've mentioned on this webinar before, at turning points, we see massive revisions. Well, such was the case with initial unemployment insurance claims, and that's a weekly indicator. So we have some of those since the crisis, and the revisions are up 25%. 25% in an indicator that the Fed's really paying a lot of attention to, and so are the financial markets. So that was kind of interesting. And then if you look at the various regional Fed indices, they're all disappointing. So the Philly Fed, the Dallas, Richmond, and so forth. Non-defense capital goods orders and shipments, both disappointing and turning down. Today we got retail sales. They were down 1% month to month. That's not a year-over-year number, which was much worse than the 0.5% decline expected. But here we have to come back to seasonal factors, and they are all messed up, I think, because of weather. So you'll remember in January, we got a huge increase in retail sales, 3.1%. Now it just seems to be normalizing. So in real terms, we think consumption looks about flat for the first quarter. So not doing too well, not falling off a cliff, but there is some equivocation there, and there was even before the crisis. Then we have inflation indicators, and those are all starting to look very good. CPI up 0.1% for March, still up 5% on a year-over-year basis, and that's what those on the Fed are looking at. Big, long lags. We just got a 0.1. That's 1.2% or so at an annual rate. That's below their 2%. Core CPI was up 0.4. That was a little higher than expected and is still up 5.6. But from there, you see in the pipeline, inflation is disappearing kind of rapidly. The PPI, Producer Price Index, this is upstream, and it will feed downstream into the Consumer Price Index, down 0.5% for the month of March, up 2.7% year over year. Okay, now we have a two handle. 2% is what the Fed is looking for, and that's down in 1 month's time from 4.9% on a year-over-year basis. So more than a 2 percentage point drop from 4.9% to 2.7% on a year-over-year basis. Even core inflation, PPI inflation, so core means excluding the volatile food and energy, down 0.1% and up 3.4% on a year-over-year basis, down more than 1 percentage point from the 4.8% the previous month. And then even further upstream, which is import prices, down 0.6% in March and down negative 4.6% year over year. So I've been saying for quite some time that we believe the greater risk out there is not inflation, but deflation. And the pipeline is starting to fill up with deflationary indicators.